Dale Briscoe, welcome back, buddy.
Morning, how are you?
Good, good. Happy New Year. I know it's a little late, but still early in the year.
Happy
So,
Valentine's.
oh, okay, I love you. And you know, here we are. I mean, it's been, I don't know, a month or so since President Trump took office and has the red wave or the new administration changed your narratives in the market. Because it's definitely there are many changes happening here domestically and geo-wise from this election, this red
Yeah,
wave.
yeah, no, I don't think it's really changed my narrative very much. Let me just share my screen with you.
Okay.
Can you see me?
Yeah.
Okay, cool. So, look, I think every time that I've been on in the last, I don't know, probably over 12 months now, the narrative really hasn't changed much at all. I mean, we can come on to Trump and Trumponomics again if you want, but let's just focus on the basics, which is um, my opinion on politicians and central bankers. They all need to be taken out back to the woodshed because they just make life more complicated for everybody. Um, the Fed are currently in a rate cutting cycle, which is both unnecessary and completely misguided. And I think at some point in the future, we'll look back and we'll say that was a huge policy error. The reason why they're cutting rates is because they have this bee in their bonnet about the economy and growth. But there's nothing wrong with the economy and growth, right? We've got the Fed minutes tonight, and I think you'll still see a fairly dovish Fed policy stance, but I think it's completely misguided.
Okay.
They
So
they've got
he's making the same mistakes we as in the 70s where
yeah
there were three rounds
yeah
of inflation. So
yeah.
we went through round one,
Yeah.
and now round two is beginning.
So I'll come. That's a great point. I'll come on to that in a second. There is an analogy with the 70s. So my point being, there's nothing wrong with GDP at real GDP at 2.5%. The unemployment rate is 4%, and the jobs market is strong. Average hourly earnings headed higher. Retail sales headed higher. Consumer sentiment headed higher. Leading economic index headed higher. Composite lead indicator headed higher. What they need to be more concerned about, apart from growth, is inflation expectations. And you can look at the time frames on the bottom of the chart, right? We are not far away from having the highest inflation expectations in 44 years. This is a problem. And the longer term inflation expectations, this is the U of Mitch 5-year inflation expectations, again, were a fraction, were a couple of point ones away from a 30-year high in inflation expectations. This is the issue that they need to be focusing on, and they're not. And I think I've shown you this chart before, which is one of my favorite charts, which is the core CPI going back 60 odd years. They tried to keep the balloon underwater with this nonsensical 2 to 2.5% inflation rate target, and held rates too low for too long. And worse than that, they goosed the balance sheet by trillions and trillions of dollars. And then they didn't withdraw it quickly enough after 2020, 2021. So the issue now is once inflation gets embedded into the system, it does not go away easily. And to mark your point, Dale, about the 60s and 70s, if we go back and we look back, this is a 100-year chart of US 10-year yields. If you see this little blue box here,
Got it.
that's basically the late 60s to the late 70s. And that period of time was characterized by a large federal budget deficit, which was financed by monetary policy. And you've effectively got that now. You've got a Fed, or had a Fed, focused on growth and not inflation, and completely took their eye off the ball. And then you had some exogenous shocks like, the oil price spikes, and that led to inflation expectations rising dramatically. And what you then had was a period of massive inflation and a massive rise in bond yields. And you can see from late 60s through the late 70s. I mean, I'm not even taking into account the peak in the early 80s when inflation peaked out. Bond yields rose, basically doubled from 5.5 to nearly 10.5. And during that period of time, the dollar actually fell 30%. So it was a fairly unique investing environment. And I think we could be about to see that again. In fact, we are seeing some of that now. And I've said this for 4 years now. We're in
Are you bearish the dollar now, Dale?
For the coming months, I am, yes. And I'll come on to that in a second, Dale. So I've said this for 4 years, and people think I'm nuts, or did think I'm nuts, less so now. I think you can see 10-year yields in the next several years at 6.5%, 7%, 8% easily. And I think that you need to bear this. This is how I run my investment portfolios. It is with a longer term view on what is happening in the world. And inflation and rates are the key drivers of markets, right? They're the biggest markets. They drive everything else. It's where do you want to put your money in that sort of environment? And it's not just confined to the US, right? I can show you. This is Eurozone inflation expectations. The ECB have basically been cutting rates and are fairly dovish. But guess what? Inflation's about to pick up again in the Eurozone. So that could support the euro. And coming back to your point about the dollar, I think just take off come down to a different time frame here because this is very long term. If you look at the Trump's first term back here from beginning of 2017, the dollar was weak for about a year or so, more than a year. When Biden was in power, the first part of his presidency, you saw the dollar getting a lot stronger. Trump's already come out and said he doesn't like a strong dollar, and that's going to be a policy focus. So for me, I think we're in the early stages of a move down in the dollar, but not necessarily for very, very long term. I'm talking now, 5-10 years. I still think the dollar is, the world's reserve currency and probably will continue to be that way. So ultimately, the dollar will win out. But you've got a period now where you could see some dollar weakness.
120.
120 on the euro, maybe, or maybe high teens, maybe. You could see it. You can see a 10% move in the dollar in the next year or so.
That'd be like 95 or 90 in the dollar, something.
Yeah, like that, right? Yeah, exactly. So how does that? So that's and I agree with Stelios in terms of what he said in terms of yields. We could see US yields lower short term, and that's because of the Fed policy, which is totally misguided. But then I think longer term rates go higher. So how does that color my perception of the world? Well, it has done for a number of years now, is you cannot fight risk assets when you have a balance sheet as bloated as the US is right now, and with interest rates still at a suboptimal level relative to where the economy and inflation is. So everything that I look at and have looked at for the last number of years has led me to want to be in risk assets and to be in assets that will be impacted by inflation in a positive way, i.e. inflation hedges. So this is the S&P, and clearly this is in an uptrend. There's nothing about this chart. This is the momentum factor ETF. Again, nothing bearish in that chart. Broker dealer ETF, nothing bearish in that chart whatsoever. and semiconductors. Okay, semiconductors have had a sell-off in the last couple of quarters, but they've found their feet again. And I think it's important to note that semiconductors are a fairly big part of the market now, and an important part of the economy as well. So if semiconductor stocks start, taking off again, that can only be good news for the stock market. And just to reiterate this point,
trying to fill a gap in the semis that it left. I think if you looked at something shorter term, you'd see.
Yes, could be.
Yeah,
I just think semiconductors are going higher, and I think the market's going higher. I'll come on to that. This is the semis relative to XLK with the tech ETF, right? So I think semiconductors are going to outperform everything in the next coming months.
Okay.
So I'll
be able to short NVIDIA at 165.
Yeah, I would say you're going to have a chance to do that for sure. Micron, big semi stock. I think that looks good. Don't forget this is a monthly chart. Remember, my time frames are usually a lot longer than some of the people that watch your program. Intel, I love this chart. Intel, huge RSI divergence on the monthly chart, right? Huge divergence. Made an ABC correction. And if you look really long term, this is bottoming out and it's going to run again, I think. So risk assets is where you want to be still. I don't see anything in any of the charts that I look at suggest to me that there's going to be a massive bear market anytime soon. Now, you'll get a signal when that's about to happen. And, if I come on the show in 3 months' time and say, hey, I think, the market's turned, you'll have plenty of opportunities to short because the correction will be fairly significant and probably fairly prolonged, but it's probably not going to happen until the Fed have stopped cutting, have changed course, started to raise rates again, and then the market gets hit. That's when you see it. So I don't think you'll see it until that point. So here's another risk asset, China. I've been banging on about China for the last few months as well. China stocks, I think, are about to take off or have taken off, and they've got a lot more room to run. This is the China Internet ETF. This is the China Dragons ETF. Yeah. All of this stuff is pointing higher to me. But it's not just stocks, right? I know you guys follow commodities a lot. This is the CRB. There's nothing bearish about this index.
No, the grains have joined the party now.
Yeah. I think you have to treat every commodity individually, but as a whole, I think commodities with other risk assets are headed higher. This is cocoa. I think I gave you this one last time I came on, right? I think we were about. I think we were just breaking out. I think we were trading around 9,000, and you had a 30% run up in that. Gold, everybody's favorite, right?
Can I ask you, do you have a view, because I'm starting to get some, I'm sure they're going to be carried with the market, but the banks, like, the XLF and banks have been leading the charge. They've held up the best when we've had little bear raids like we had in December. And, some sharply, it was, 200-point range the S&Ps were in. Is that a bullish looking chart to you?
There's nothing bearish about any of the charts I'm looking at. Nothing.
No. Okay.
Nothing. And it's just, I think it's Dale. It's like shooting fish in a barrel at the moment, thanks to the Fed criminals, right?
Yeah. I'm just seeing momentum divergences for the first time there.
Yeah.
We didn't have them till this week.
The thing about momentum divergences is that they can go on for a very, 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 very long time.
Oh, my P&L has learned that.
Yeah. Okay, so here's, I think I sent you this the other day, didn't I? I think it was last week, and I was trying to get a reminder about when I was coming on, which is, this is the Mag 7 ETF.
Oh, yeah.
Tell me what's bearish about that chart.
Nothing. That's why I got out of my NVIDIA puts last week and everything. So I'm looking for a melt up too. Do you have an S&P target?
I think short term in the next month or two, I think you can easily see 64, 6,500. I think tech is probably going to lead the way, and semis are probably going to lead those. But I would not listen. I'm long of risk assets, have been for the last 4 years. I don't think there's anything out there right now to convince me to be short of the market or short of risk assets of any variety. I just don't see it. With the Fed cutting rates and with the balance sheet still bloated, there's still too much capital in the system.
So
And,
maybe
and,
you're
and
more in the maybe you're more in like the 7,500 camp for S&Ps. There are people that are there.
listen, I think anything is possible right now because you have a central bank that is too easy, both in terms of its rate policy and in terms of its balance sheet. You have a president who's just come in who is going to crank up growth and is probably going to have a fiscal policy to stimulate when it's probably not necessarily needed, but that's his way. So there is nothing getting in the way of risk assets. I don't see it unless you get some kind of exogenous event,
Yeah.
which a black swan you can't see, a COVID 2020, a global financial crisis, but that doesn't happen overnight.
Well, do you want to know what it's going to be?
If you know what it's going to be, it's not a black swan.
Well, I'm the only one that knows. Oh,
It's it's
two other guys know.
tell me.
So it's a gray swan, like my hair.
Okay, tell me.
That Netanyahu was here to draw up battle plans to take out Iranian nukes in the next month or so. And Iran's not going to respond by going after Israel. They're going to go for Saudi Arabia. And just like the oil shock you were talking about before, I think crude goes into the low 60s first, but then I think we're going to have an oil event in the Middle East. That's a,
Um,
that's what
you
I
could
think.
okay. I'm not sure about the whole Netanyahu Israeli policy over the next coming years. Who knows? I don't get involved in politics. I think you have a rule on
Uh,
your show about not doing political stuff. I
well,
certainly
I'm just
not.
saying what I heard President Trump say, that Iran could have everything but a nuke. Okay,
Yeah,
so
I don't get involved in politics, and I dislike politicians of every shape and size and form.
I
Um,
know, but
uh,
I still have to be aware of potential
you
narratives.
you be aware of that. But Dale, you and I have both been in the market a very 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 long time now, and we all know, or we know, that price
Yeah, that
moves ahead of narrative, not the other way around. So at the
not
moment,
always.
everything in terms of price is telling me otherwise, is telling me there's nothing here to worry about right now. So that's how I'm positioned. And it's not just stocks, it's not just commodities, it's crypto, this is big
Everything.
this is
Ev-
Bitcoin. I'm still long of Bitcoin. I'm still long of Bitcoin miners, right? If you can't trade Bitcoin, then trade one of the mining stocks. MicroStrategy is a relatively decent proxy. And I'll just finish off with, some of the stocks that I kind of like. This is Rich Tech Robotics. They make robots that do various chores around hotels, restaurants, and factories. I think that's going to have a very big move. Um, Archer Aviation. They make the electric vertical takeoff and landing aircraft. This looks positive to me.
Interesting
ASTS.
names.
Yeah, ASTS. I mean, I focus, as you probably remember, on the mid cap names.
Yeah,
That's what we do. Mid cap US long short for Citadel and BlackRock and a couple of the big hedge funds. This is AST Space Mobile, which obviously is doing its broadband network in space, which is the next step forward in cellular communications. And then
yeah. I think they're
another one.
doing it here already. Forgot the carrier, but they're your cell is hooked up to Starlink through them.
Yeah, I'm obviously in the UK, so I don't know what you've got going on. And this,
Yeah.
I've just finished on SMCI.
T-Mobile. Yeah.
Yeah, so I'll finish on SMCI, which I've been long for a while now. Um, I love this chart.
One blow off coming with Bitcoin.
I think, yeah, I mean, just to remember the time frame. So, this is going out probably end of 2025 is, where are we? It's probably around about there, isn't it? So, yeah, plenty of room this year for more upside. Look,
Do you think in terms of time? I know everything looks great. I'm looking for 6,400 too. Do you think it's going to be we've really, before this week, we've been in a range in both NASDAQ and S&Ps. Shouldn't it really just get going from here and stop grinding?
I think it's primed. I think it's ready, and maybe the Fed minutes tonight will give it a jolt. Look, you're right. Some of the charts look messy, and what I try and do is when I see a messy chart, and you pick any one of a number of
Like
charts, right, that look like,
Microsoft?
yeah, that look like, yeah, exactly. So you pick any individual stock in the Mag 7, and there may or may not be a discernible pattern. So then you fall back on, okay, well, what do I look for in terms of, okay, this is the composite, right? This is the composite
Yeah,
of all the Mag 7. That's a
right.
much cleaner looking chart to me. So
Yeah,
trade that. Don't trade, individual names. If you can find an ETF that gives you a broad exposure and looks like a clean chart, then just go for it. The same
good
with
advice.
the same with the S&P and the Nasdaq, because I think if you look at the NDX or you look at the Dow or look at the SPX and it looks very confused, try and find a chart where the pictures are pretty, and that's what I do. I look for pretty pictures, right?
Yeah.
I've got a master's degree in engineering from one of the world's top universities, as Stelios knows. But I'm just a visual guy. I'm just a visual guy. I like nature, I like beautiful things in nature, I like beautiful architecture, and I like beautiful charts. So this is a picture perfect chart, right? From an Elliott wave perspective, this is the NASDAQ comp,
Yeah.
which is a much bigger index, and it's a much cleaner chart because you can see you've got from middle of last year, you've got a wave one up, a wave two back, then you've got a big wave three. If you draw an Elliott channel from the top of wave one to top of wave three, and then from the bottom of wave two, the wave four comes in almost picture perfect at the channel, right? And then from there, you've got a delightful first wave up, second wave back, and then you've got another first wave up, second wave back. So this really is primed to go. So within the next week or two, especially if you look at the Mag 7, which I think is also basically ready to go as well, I think you've got a period of the next 4 or 5 months till the end of the quarter, probably, where you should have plain sailing, right?
Yeah, maybe until April,
Yeah. Look,
May.
I'm not going to try and put a time frame on it because, as I said,
Try.
there's nothing that I can see that causes me to be bearish yet. And
Right.
my
So
nickname is
why
the
even think about it?
yeah, exactly. Don't think about it.
Yeah.
Don't try and fight it. Don't try and be a hero and pick it up. The worst thing you can do is try and second guess the market and try and be a hero that called the top. Don't do it.
Well,
Don't
I
do it.
tell you, man, I had to buy a lot of puts when I saw the Stargate project in the Oval Office. And they came in and semis ripped, and it was a failing rally in NVIDIA. And then just, I guess, pure luck, you know, deep six. So, that's why I'm saying that even within, now this isn't a stage where you could trade. It's not a two-sided market when you get into a melt-up stage. It should lift all boats, right? But when you're in ranges, bulls and bears can make money.
All risk assets, I think, are going
Yeah.
to continue to benefit from easy Fed policy, from a misguided rate cutting cycle,
In
from
April?
I listen. It if they get some uh if they get another if they get another inflation print, which is unhelpful, then I think you'll start to see the rhetoric changing.
Yeah, I think it's already is. I mean, I hear people say maybe he's going to have to hike again.
There's no doubt in my mind that this rate cutting cycle will go down in history as a huge policy mistake. And um, where was I showing you that? Just go back to the uh, just go
So,
back to this chart, right?
yeah,
Um, sorry. Just go back to this chart.
yeah.
The policy mistake in the late 60s to the late 70s
Arthur
is
Burns.
being repeated.
Yeah. So
A
he's
Fed
not Volcker.
a Fed no it's a Fed focused on growth
Yeah.
when and not inflation when they should be the other way around. And so you're old enough, as am I, to remember the inflation that we had in the 70s, and it's abominable, it's despicable, because the people that can afford it least are the people that get hurt the most. The haves, the people that are wealthy and have assets and they have money to invest and they can put their money to work into inflation hedges, will be fine by and large. But the people that don't have that fallback will be the people that are having to fork out more every month for housing, food, energy, and it's wrong.
Do you remember a guy, an author named Ravi Batra?
Yes, I think we had this
Okay.
conversation last time.
Oh, did we? Because I
I
mean,
think we did.
you talk about wealth disparity. So I mean, it's never. He thought it was way out of whack in the '80s. The Depression of 1990 was the title. So can you imagine from the '90s with all the printing and asset inflation? The disparity now must be like it was during the French Revolution.
It's horrible and it's getting worse and it's despicable. That's all I'm going to
Yeah.
say.
All right.
That's why my view on politicians and central bankers.
Where's your bunker?
Uh, sadly, in the UK, we're not allowed to have guns. So
Oh,
the beans, bullets, and beer and bunker quadruple don't exist over here.
all right. Yeah, that's right. You're on the other side. All right. Well, I tell you what, it's great insights and really interesting stock selection for this part of the market. So, everyone, this is recorded. So, if you didn't write them down, Dale's had a great track record, not only when he's on the show, but in his trading. That's why he's managing and doing what he's doing. And you could tell why. And the main ingredient that I see in Dale is he uses a telescope, not a microscope. So another great conversation, Dale. Really appreciate it.
My pleasure, Dale.
Yeah, I hope it's a great year for you.
Uh, we had a spectacular, or I had a spectacular year last year. The long short
Nice.
books, long short US equity market neutral books that we run for some of the big hedge funds were up over 100%. So we had a
Yeah,
spectacular year.
yeah, that,
I'm hoping that this year will be equally good, but I suspect that it will be more challenging as we go through the year.
yeah, yes. When some of the animal spirits start to run out of juice. So
Exactly.
we'll see. Always great, and appreciate you coming in and edifying our community. Thanks for paying it forward here at Face, my trading warrior brother.
Say hi to all the gang for me. You guys do a great job, and I've been around the industry a long time, and it's nice when you get to my position that you can spend time giving back and paying it forward, as you said.
Yeah. Okay. Well done. We accept the knowledge. Give me a Y if you accept Dale's knowledge today. You
Just
know,
remember,
we're
just
go
remember,
ahead.
Dale, I've been doing this for nearly 40 years and I've done tens and tens of thousands of trades during that period of time. And statistically, I'm only right 62% of the time. So don't shoot me if one of my predictions is wrong.
No, that's a great hit rate because the difference between pros and amateurs is they know how to lose.
Yeah, exactly.
So, Dale Briscoe, everybody, talk to you in the spring. How about
Yeah.
that?
Yeah. Sounds good to me, Dale.
All right.
Enjoy the next few weeks and months.
All right, Dale. Thanks very much. Dale Briscoe, everyone. Dale is on LinkedIn. You open to people connecting with you, saying hello.
Yeah, I've come off of X, as you know. It was
You're
just
right.
getting too much of a time constraint.
Yeah.
So I don't do social media. I'm not selling anything, but if people want to connect, that's fine.
Okay. So there you go. You could find Dale on LinkedIn. That's a wrap. You could join the team in 14 minutes. Remember, don't just count your pips, count your blessings. Good hunting today, everyone. See you tomorrow. Um, yeah, tomorrow I have Ben Maldonado. And then I have a grain person coming because the grains have come out of the hole. So that's a wrap for me, and we'll see everyone tomorrow. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.